Sandip Agarwal, fund manager, Sowilo Investment Managers. The IT stocks have been under pressure from the start of the year. The index, the Nifty IT index, is down nearly 30% at a 3-year low. And the valuations of many IT companies are now down to the lowest level that we've seen in many years. Large cap IT is trading at 13-14 times, so very close to trough levels. Where do we go from here? Yesterday, we had a rebound. Sandip Agarwal, fund manager, Sowilo Investment Managers, is now joining in. Sandip, I remember you were bullish on the IT stocks once they'd started correcting. You thought the correction was overdone or done for now. But, you know, every month when we look at the index, at least in 2026, it's been lower than the level that it was a prior month. Where do we go from here?
Yeah, hi, Rima. Good morning. Thanks for having me on the show. So, Rima, you know, since March, we have turned positive, and from there also, most of the stocks are down 10 to 15%. But let me tell you, Rima, this in last 25 years since I'm tracking this sector, I also have done the same mistake, and I see today also most of the analysts and people who are making a view are going through that challenge. They are confusing the disruption with the cycle. See, these are two different things. Disruption is one and cycle is different. In past, what has happened, all disruptions, there was never a change of in the effort count. It always used to go up with a pause. And because we are in the third layer of the cycle, that is, we don't make the product, or whether it is hardware or software, neither we use the product to generate or commercialize it. We are the third who service the product. So we are basically customer service partner of the whole ecosystem. So we always get impacted the last, and we also recover the last. Unfortunately, you know, this cycle cannot change just because there is a change in technology, there is a change in disruption. And this time also same thing is happening. People are confusing the disruption with the cycle. Cycle will play in the same way. Initially, the hardware of the innovator will gain in a big way, which we have seen in NVIDIA and AMD. Second phase, the people who use that technology and make commercial use of it, like the Anthropic's group and all the AI players, they will make a lot of money for next 10-15 years. And once they start commercializing, after 16 to 18 months of lag, we will come and service those clients. So when the enterprise AI gets adopted, our role will come. So the cycle doesn't change this time also. And that is the reason last 14-15 months, when we have a view 50% correction at index level, and we turned positive since last 1.5 months, and we have actually added quite a bit of weight in the sector. I'm very positive on the sector now. Again, remember, my view is it is a lower growth for longer, but these valuations are not justified for even the lower growth for longer. I remain cautious still on the ER&D. I still believe there is a lot of growth in the ER&D space. So I will not buy any ER&D stock, but I will buy the traditional IT services stocks with a preference for the lower and mid-sized companies which are at very reasonable valuation. And also some bit I will add in the large cap. That is my view.
But with large cap, when does the cycle turn? You said that the Indian IT comes in the third level of the entire technology cycle. The first beneficiaries are the NVIDIAs, second will be the Anthropic OpenAIs, and then come the service providers like Indian IT. Where are we in the cycle? Because at least as of now, we haven't seen any signals which suggest that the application layer where Indian IT comes in is benefiting.
Rima, you know, no one knows when it turns. I will tell you, post-COVID, when market was 7,000 and all these stocks were like, you know, have corrected 60-70%. That time, when we did channel check, we got good filler that demand is coming. And, you know, when we were pushing initially, no one was believing. And when we were saying positive, the stocks were down 5-10%. And this time also, it will be no different. My view is that, you know, large part of deflation in the efforts has been priced in. So I think worst will be this quarter. Maybe this will be the inflection point of the turnaround. And from next quarter onwards, I don't see any decline in growth for any of the companies, barring one or two which have internal issues for a long time. I will not comment on them. But otherwise, most of the companies will see growth from this quarter or maybe next quarter. And once that happens, and this, remember that this cycle, I'm very confident it is a profit growth cycle and not a revenue growth cycle. So growth will be 6-7% for the large cap, and for the mid well-run companies 10-12%. But profit growth will be much more substantial in this cycle. And I think stocks will make good return from here. That is our view, and we have substantially increased our weight in the PMS also.
Right. And Sandip, hi, morning. Good to see you again. So for regular viewers who are watching, right, is what's the way to get exposure? You know, you're a specialized. You do this for a living. So maybe give money to you, but if they're going to do it themselves, buy a IT ETF or something, or buy 2-3 stocks. What's the best way?
I will strongly recommend to buy, you know, IT ETFs, and I'm reasonably confident. See, I will not be able to say that whether they will fall from here 5-10%. I cannot give that call, but I am reasonably confident that if you do the numbers, the EPS has to grow by 45 to 70% in next 3 years from here, in worst case scenario. So I believe that at same multiple also, these stocks will give you 45 to 70% return in next 3 years, which is anywhere between 12 to 20% CAGR, which is very good return, and there will be some re-rating also.
And if one were a bit more aggressive and wanted a bit more concentrated exposure, 3 names which you think will do the best position.
I will not give you a name, but I will say wherever, traditional IT services where multiples are reasonable, you can buy them. Avoid ER&D at any cost. I think ER&D is still too much overvalued. There will be lot more correction in ER&D space. So I'm telling you what not to buy. What to buy, you can buy anything, you will make good money in the traditional services side.
Saying that ER&D companies are overvalued. Now, KPIT Tech, after a 50% correction from the top just in this year itself, is now closer to 20 times, 19 times forward multiple. What would be the appropriate valuation multiple you will assign to the ER&D companies, or particularly if you want to specify by KPIT Tech?
I will not specify on KPIT, but let me tell you, you should go and see how EPAM has lost market share to the Indian ER&D companies post the Ukraine war started. And from that, you will get clue that, lot of demand, lot of market share gain has happened. I don't know whether that market share gain is permanent or not. Assume that it is permanent, then also at this base growing at, significant rate will be tough. If, God forbid, some market share is lost again, once, there is some peace there, then obviously, these companies are extremely overvalued. Let me put it this way that, good correction has happened. So my call 15 months back was that IT services should correct by 50% and ER&D by 70%. IT services has corrected by 50%, ER&D has not corrected by 70%. So I will wait at least for 20% more correction across ER&D, and I am not calling out any name on that.
All right, another 20% correction on ER&D is what your call is. Sandeep, just one word finally. You said traditional IT companies is something that you like already. Would it be across market capitalization, or would you bet on only large caps right now?
No, across market capitalization, IT services across market cap PEG ratio close to 1.5, 1.6 is where my comfort is. I will not buy company where, last 10, 15 years there has been some or other issue and they have not done well, because those are very, very internal issue, although they may also do better. But I will not buy. Other than that, the top 2 IT companies I like, and I like, few more names, smaller ones. And I think, there's too much of pessimism. If you do the number on Excel, and I'm sure some analysts someday will do that number, and when they do that number, they will be shocked that, the stocks are really, really massively undervalued.
Yeah. But what a change, right? It used to be buy ER&D, that is where the growth is, ignore everything else. It is now completely flipped, right, Sandeep?
Yeah, so, because the valuations have gone through the roof, and I'm sounding caution for last, I think, 4, 5 months, 6 months that don't buy ER&D.
No, you've been... Yeah, you've been cautious, but I'm just saying, I mean,
So, Prashant, ER&D will grow at a 2x rate of IT services. That is given.
Yeah.
But then also the multiples don't justify.
Got it. It's possible to overdo a good thing. I guess that is what has happened with some of the ER&D companies, as you're pointing out. Thank you very much, Sandeep. Great speaking with you. Appreciate you joining us. As always, I think the IT index at the end of the pre-open session is up about 1.5%. Actually,